Gold, silver, cash, stocks, bonds, commodities, or real estate? Where should you invest? So, which is the best asset class to be invested in right now? Well, before we come to that, and before I share how I'm invested, what I do want to share is a part of my portfolio. Now, I've talked to you guys on this channel for the last 18 months now, how a percentage of my portfolio is in US dollars. Why? Because of the dollar milkshake theory, because of the macro environment. And what is the dollar milkshake theory? So the dollar milkshake theory is when capital flows into the US dollar system. US dollar is a global reserve currency, so many nations buy and sell goods in dollars. Nations also hold debt in dollars that must be serviced, payments made. And we're going to come to that because that is very relative to Australia at the moment. And as economic conditions worsen outside the US, these nations still need to buy dollars for trade and debt servicing, even though there is a de-dollarization happening around the world. And the milkshake analogy means other nations continually inject liquidity into the US dollar, which sucks it up through its straw. In the future, the massively inflated US dollar balloon could pop or will pop, but unclear when that could happen. And look, Brent Johnson, who created this, does agree that the end game is you want to own gold, you want to own silver. And he agrees with the likes of Peter Schiff, what the end game is. But there's this, dollar milkshake theory to play out, and it really makes sense. So we have fast rising dollar price creating problems for other countries. Imports and debt service becomes more expensive. And this is once again why, as an Australian, I'm invested in US dollars at the moment. Even though the dollar supply has increased, other nations keep dollar demand high, which drives up the price. Now, you know what? What I'm going to do now is share a little clip, little 6-minute clip from Real Vision, where it's one of the best videos that explains the dollar milkshake theory.
A giant milkshake of liquidity has been created by global central banks, with the dollar as its key ingredient. But if the dollar moves higher, this milkshake will be sucked into the US, creating a vicious spiral that could quickly destabilize financial markets. The US dollar is the bedrock of the world's financial system. It greases the wheels of global commerce and exchange. The availability of dollars, cost of dollars, and the level of the dollar itself each can have an outsized impact on economies and investment opportunities. But more important than the absolute level or availability of dollars is the rate of change in the level of the dollar. If the level of the dollar moves too quickly, and particularly if the level rises too fast, then problems start popping up all over the place. And that's why everyone should have a plan for a rapidly rising dollar. It doesn't need to be a base case, but it never hurts to be prepared. Today, however, many people are convinced that both the role of the dollar is diminishing and that the level of the dollar will only decline. People think that the US is printing so many dollars that the world will be awash with the greenback, causing the value of the dollar to fall. Now, it's true that the US is printing a lot of dollars, but other countries are also printing their own currencies in similar amounts. So in theory, it should even out in terms of value. But the hidden issue is the difference in demand. Remember, the global financial system is built on the US dollar, which means even if they don't want them, everybody still needs them. And if you need something, you don't really have much choice. And although many countries like China are trying to reduce their reliance on dollar transactions, this will be a very slow transition. In the meantime, the risks of a currency or sovereign debt crisis continue to rise. For now, countries like China and Japan need dollars to buy copper from Australia. So the Chinese and the Japanese want dollars, and Australia is getting paid in dollars. Europe and Asia currently do a very limited amount of non-dollar transactions for oil. So they still need dollars to buy oil from Saudi. And again, dollars get hoovered up on both sides. Asia and Europe need dollars to buy soybeans from Brazil. This pulls in yet more dollars. Everybody needs dollars for trade invoices, central bank currency reserves, and servicing massive cross-border dollar-denominated debts, of governments and corporations outside of the USA. And the dollar-denominated debt is key. If they don't service their debts or walk away from their dollar debts, their funding costs rise, putting great financial pressure on their domestic economies. Not only that, it can lead to a credit contraction and a rapid tightening of dollar supply. And the US is happy with the reliance on the greenback. They own the settlement system which benefits the US banks, who process all the dollars and act as gatekeepers to the dollar system. They police and control the access to the system, which benefits the US military machine, where defense spending is in excess of any other country. So naturally, the US benefits from the massive volumes of dollar usage, and other countries have naturally been grumbling about being held hostage to the situation. But their choices are limited. What it does mean is that dollars need to be constantly sucked out of the USA because other countries all over the world need them to do business. And of course, the more people there are who need and want those dollars, the more is the pressure for the price of dollars to go up. In fact, global demand is so high that the supply of dollars is just not enough to keep up, even with the US continually printing money. And this is why we haven't seen consistently rising US inflation despite so many QE and stimulus programs since the global financial crisis in 2008. But the real risk comes when other economies start to slow down or when the US starts to grow relative to the other economies. If there is relatively less economic activity elsewhere in the world, then there are fewer dollars in global circulation for others to use in their daily business. And of course, if there are fewer in circulation, then the price goes up as people chase that dwindling source of dollars, which is terrible for countries that are slowing down because just when they are suffering economically, they still need to pay for many goods in dollars and they still need to service their debts, which of course are often in dollars too. And so the vortex begins, or as we like to say, the dollar milkshake. As the level of the dollar rises, the rest of the world needs to print more and more of its own currency to then convert to dollars to pay for goods and to service its dollar debt. This means that the dollar just keeps on rising. In response, many countries will be forced to devalue their own currencies. So of course, the dollar rises again. And this puts a huge strain on the global system. To make matters worse, in this environment, the US looks like an attractive safe haven. So the US ends up sucking in the capital from the rest of the world. The dollar rises again. Pretty soon, you have a full-scale sovereign bond and currency crisis. We're now into that final napalm run that sees the dollar and dollar assets accelerate even higher. And this completely undermines global markets. Central banks try to prevent the disorderly move. But the global markets are bigger and the momentum unstoppable once it takes hold. And that is the risk that very few people see coming, but that everyone should have a hedge against. When the US sucks up the dollar milkshake, bad things are going to happen. Worst of all, there's no alternatives. What are you going to do? Yuan? The yen? The euro? Now, like it or not, we're stuck with the dollar, underpinning the global financial system. And that's why we all need to pay very special attention to the dollar milkshake theory.
So if you haven't yet watched my last video, Will the Fed Destroy the US Dollar or Asset Prices? I shared a bunch of charts and talked about Jerome Powell's speech at Jackson Hole. And I've got a little bit more information to share with you guys from that video. So I'll put a link in the description below if you haven't watched it. So you've probably seen this chart before. This is just the Fed hiking cycles that always end with deleveraging events. And, well, we're in that hiking cycle right now. We've got an almighty debt bubble. People went out and borrowed and leveraged as rates. We've had this 40-year bond bull market, so rates have just gone down to zero, increased people's borrowing capacity and purchasing power. But I argue that we're going to see a deleveraging event like 1973-74 because I think inflation is driven by the CPI that we're seeing is driven a lot by energy this time around. So yes, we've created a lot more currency right across the globe, and we locked things down. We locked the country down. We stopped production. supply chains were hit. And so that's literally, the definition of inflation is the expansion of the currency supply, credit or currency supply. Prices are another thing. Prices are then determined by the demand for those dollars. So the goods and services that it's chasing. And so we destroyed supply. At the same time, we increased new dollars. They're going to have to send us into a depression to get the aggregate demand level down to the supply level, because the supply level has fallen so far. And we've got, I've shared on this video so many times the chart of oil and CPI. Go have a look at it. And, the way the globe has, especially in the Western world, regarding climate policies and energy policies, I've argued we're going to be in an inflationary decade ahead. And so as we raise rates, it's going to be asset prices that were pumped up by debt that are going to experience this deleveraging event. But I don't think CPI goes negative. So I think we have deflation in assets. I don't think we have deflation when it comes to CPI. And that's my argument. Now, you've probably already seen this chart, but the US 2-year yield has climbed to the highest since November 2007. It speaks for itself. So we can see that the global currency supply, so liquidity is being drained out of the system, yet what we're hearing from the Fed, the real liquidity hasn't even yet started. So, watch this space. And this is a awful chart if you've just bought a home. If you're a recent first home buyer, I would not want to be looking at this chart right now. So US total homes under construction and new one-family home sales. Home sales are falling. Construction rose. This is not a good chart if you're a recent first home buyer. Now, coming to Australia, just yesterday we had our finance numbers out, our housing lending numbers out. And, well, I've argued, based on Austrian economics, with the crack-up boom, we've seen a crack-up boom in new loans. Look, new loans skyrocketed. Look at that. Went vertical. That was never that was never sustainable. This was always going to pop, and this excess is going to come out of it. The question is how far does this fall? So overall housing numbers came out month on month, down 8.5%. Year on year was 11.3%. For owner-occupied lending, it was down 7%, but in year on year, it was actually nearly 16%. But investment lending was down 11.2%. And this is national. When we break it down to states, Tasmania led the way, almost 22% fall. Victoria, 14.5% fall. Queensland, 12.6% fall. We're supposed to be getting the Olympics, and that's supposed to be a boom for property prices. And, Queensland's cheaper than New South Wales and Victoria, and everyone's fleeing from Victoria, moving up to Queensland. And, so our housing market's supposed to be booming. Well, credit has fallen, and now housing prices in Queensland have overtaken the pace of falls than Victoria. So why am I doing this video? Why am I sharing this with you? Why am I talking about the dollar milkshake theory? Well, especially for Australians, but this goes for everyone, especially in Europe and other places, mind you, and Canada as well, New Zealand, but also my friends in the US. But I want to speak to my Australian audience right now. Why it's so important to understand the dollar milkshake theory. And we looked at the part of it around foreign exchange reserves, and debts are in US dollars. And, as we trade and sell products, we receive US dollars. Well, John Adams is an Australian economist, for those that don't know. And he is one of only 3 Austrian economists in Australia. We don't have very many in Australia. Now, he did a video recently where he talked about how Australia could very well become Sri Lanka. Now, I'm sure you've all seen the footage on the screens in Sri Lanka where they've run out of fuel, they've run out of gas, they've run out of food, and they stormed the presidential palace. Now, people might think that's a bit extreme. Australia will not become like that. However, something that I've been arguing and why the dollar milkshake theory makes sense as an Australian investor, why I'm holding US dollars. And by the way, I've had conversations back and forth with Brent Johnson. Brent Johnson has a trade that the Aussie dollar is going sub 40. That's even lower than what my target was. I can see it hitting about 50 or maybe going just sub 50. Brent Johnson says that Australia's in big, big trouble. And so does John Adams. And so instead of me explaining what the problem is, what I'm going to do is cut to a couple of little clips I put together from that interview that John Adams did. And I highly recommend you guys watch the whole video. I'll put it in the link in the description below. And then at the end of it, I'll talk about how we are invested based on this macro outlook.
One of the key things for our audience to understand is that foreign debt problems don't occur overnight. I mean, they take time to build. And so over the last few years, the Sri Lankan economy has had this huge foreign debt problem, and it has exacerbated with the COVID-19 pandemic. So where a country gets into problems is when you don't have enough foreign exchange reserves. So basically enough reserves of foreign currencies. So when your foreign bills come up, that you don't have enough to pay them. Now, in the context of Sri Lanka this year, 2022, Sri Lanka was required to pay, and is still required to pay $7 billion of foreign debt. And as of April, they only had about I think $1.5 billion. So they basically have a depleted amount of foreign reserves, and that depletion of foreign reserves has gotten worse over the last couple of years. Now, two really big aspects in the case of the COVID-19 pandemic over 2020 and 2021. One was that they saw a major decline in tourism, and obviously if you have less tourists, with less foreign currency coming into your country, you basically can't collect those foreign US dollars or Chinese yuan or euros, etc. And that was a big factor. The other thing is that they had they banned petroleum-based fertilizer, and this was a disastrous policy that led to food crops in Sri Lanka falling by about 50%, particularly in terms of rice. And so they had a major slump in agricultural exports, which again didn't allow them to generate enough foreign currency reserves. And so this is why this issue became acute, particularly in terms of the beginning of 2022. Now, in the case of the decision around fertilizer, now there is two schools of thought as to why Sri Lanka did this. One is that it was related to climate policy, and that there was some urging from the World Economic Forum to ban petroleum-based fertilizer. Another school of thought, and this is some of the Financial Times of London, suggested that they were nervous about spending foreign exchange reserves on additional fertilizer. And that's why they said, well, we need to try to keep as much foreign currency as we can without spending it willy-nilly. And they basically said to their agricultural sector, we want you to go organic and don't use fertilizer. But that was a disastrous policy. And these are the two key factors that led them to a point of crisis at the beginning of the year. Now, fast forwarding a little bit, obviously we've had surging inflation globally, and that inflation pressure has been feeding through to the Sri Lankan economy. So when you've got rising inflation as well as depleted foreign exchange reserves, Sri Lanka over the last 12 months have had problems with the importation and the production of food, the importation of fuel, but also in terms of medicine. And so Now, the other key point is Sri Lanka has had a fixed exchange rate, and so when you fix your exchange rate to maintain that peg, if you have surging inflation, and one of the things we've seen over the last 6 months is the surging US dollar. Well, you need more US dollars to pay your foreign debt, and so the key critical juncture that led them to this point of crisis was that on the 9th of March, they couldn't maintain their exchange rate because they were bleeding too many US dollars and they were running out, and so they decided to release the peg, and what that meant was that the exchange rate collapsed, or the currency collapsed on the exchange rate by about 70%. So it was definitely a shock to the system. Now, at this point in time on the 9th of March, where in terms of the currency collapse, the Central Bank of Sri Lanka wasn't willing to raise interest rates to the appropriate level to maintain the value of the currency. So one of the things we've been saying over the last few episodes in terms of whether it's the US or Australia or some of the other economies, if you want to get inflation under control, you need your interest rates above the exchange rate. So prior to them surrendering this peg on the foreign exchange, inflation was ranging about 15 to 20%. Now, as the situation has unraveled in Sri Lanka, for June, inflation has now peaked at 54%. And for food in particular, inflation is running at 80%. And so basically, if you're poor in Sri Lanka, you can't eat. So when we bring this to a close, Martin, is so what are the lessons for Australia? So we have a foreign debt problem. Now, we're going to cover this in a future post, but one of the big concerns that Peter Brain had was how much foreign debt do we owe within the first 12 months? Now, when we did the show in 2019, it was about 700 billion. I looked at it over the last 24 hours. We owe about 928 billion of foreign debt with a 1 year maturity or less. The amount of assets we have is about $250 billion short of that. And so we have a gap of our 1 year maturity foreign debt to the tune of 250 billion. And when you look at the foreign exchange reserves at the RBA, it's not that, it's only about 80 billion. So if we had a situation where our creditors lost confidence in our ability to repay, the amount of money we would have to stump up in a 12-month period, we're short 250 billion. The RBA doesn't have 250 billion to meet that gap, and we could easily go into a Sri Lankan situation if things were to unravel. And while some people may think this is perhaps a bit of hysteria in the case of our discussion vis-a-vis Australia, this scenario is what Peter Brain, who has a knack for forecasting crises, and we discussed that in the last post. This is what this Sri Lankan situation is what he precisely predicted for Australia. So while the RBA is saying we're going to raise rates in Australia to get inflation under control and to try to slow down the economy, in the background, what the thinking at the RBA would be is if inflation starts to rage out of control relative to our peers, and if we keep interest rates too low, particularly compared to the Americans, the exchange rate's going to collapse, and that could have a balance of payments crisis like we did in 1985-86. And then at that point, then you have a really critical decision as to, do you save the currency? And if you, by saving the currency, you've got to dramatically raise rates, not like we have in the last 3 months, but you basically have to go 5 to 10% very quickly, like what has happened in Sri Lanka. Or if you don't save the currency, then you end up in a foreign default, and then you have runaway inflation in the order of 50 to 100%. So these are the nightmare scenarios. But obviously, we haven't sort of put ourselves in a good position, and so again, one of the key messages we've been pushing for the last 4 years as we've been doing this show is a lot of Australians think that we have a standard of living which we earn or we are entitled to. No, the last 20 to 25 years, we have lived a particular way in Australia using a big international credit card. And in net terms, we owe the world $1.2 trillion. In gross terms, it's about $2.5 trillion. And so that's why we live the way we live, not because we produce goods and services and sell them to the world, that they want to buy our products at prices we can charge. It is because we are living beyond our means, and not just in terms of the household sector, government and the corporate sector as well. And so we've got a big international credit card that we have to pay, and so unfortunately we don't have anyone who is willing to come to our rescue at this point in time.
So as I said, I'll put a link in the description to that full interview with John Adams, and I highly recommend you guys, especially Australians, watch that, because it's going to have a big impact on your investment portfolios, no matter what asset class that you hold. And this is something that I've seen coming for quite some time, hence why I've built my portfolio around this potential thesis. And it's interesting because, once again, in my dialogues with Brent Johnson, he sees in this dollar milkshake theory both gold rising at the same time as the US dollar rising. So they rise together. And the US dollar is the last fiat currency to collapse. It makes sense to me. And that also is one of the reasons why I hold so much US dollars. But it also benefits my gold and silver holdings, because if gold is rising as the US dollar is rising and the Aussie dollar is falling, well, guess what? We're getting double the whammy. Gold is going up along with the dollar. Because the dollar's going up, our dollar's going down, which in Aussie dollar terms, the gold is going up even more. So is gold and silver the best investment right now? Well, it's definitely one of the best. How are we invested? Well, I've shared on other videos. Yes, we hold a lot of US dollars. We hold a lot of gold and silver, but both physical, but also miners, developers, explorers. We own biotechs. We own drilling companies. We own energy. Heavily invested in the commodity sector, but strategically invested. We trade options. We do all that. And if you guys want to know exactly how I'm invested, exactly which stocks I'm invested in, why I'm invested in particular stocks, particular asset classes, and you want all my research and analysis, then we have Finance Uncut Insiders, which I've spoken about on the last several videos. And it is a weekly report of our portfolio. Everything that we own, all of our research and analysis when we're selling investments, why we're selling investments, you guys can get access to that. Now, it's not financial advice and it's not a recommendation to buy or to sell any particular investment. But if you guys want an inside look into how we invest and what we invest in and why we invest in it, then send me a link, send me an email, to the email address that's on the screen below. Now, for an annual subscription, it is $1 a day, $365 for an annual subscription to this weekly report. However, I've mentioned that we haven't yet launched it. I have said that we need a minimum number of subscribers to make this work. Now, I'll let you guys know. That minimum number that I had preset was 200 people. We're at 150. So we're still 50 people short before we launch it. So if you are interested in it, we are giving a 30% off for the first year. So it's going to be $255.50 US. That's in US dollars for this weekly report of our investment portfolio. So if you are interested, send me an email below. We haven't yet responded to anybody because we want to get this minimum number. And the minimum number is 200. So we're 50 short. So if you are interested, send me that email. And as soon as we hit that 200 mark, we'll launch it. And we'll let everybody know payment details, and you'll start getting that report. Anyway, guys, love to see your thoughts and opinions in the comments below. Which asset class are you investing in? How do you guys see this macro outlook playing out? Once again, if you like this video, please hit that like button. Really do appreciate it. Take care, everyone, and I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.